Investing sounds complicated, risky, and maybe even a little intimidating. But what if I told you that there's a way to invest in the stock market without picking individual stocks, without spending countless hours researching companies, and without needing a ton of money up front? In this video, we'll break down passive investing and why it's such a powerful strategy for building wealth. Saving alone is not enough. If you decide to put money into your bank account every single month that you've been earning and trying to save it that way and gain wealth over time, you will actually end up losing money over time. This is because there is a process called inflation that eats away at your savings every single year. Now, the average inflation rate per year is 2%. And to kind of visualize what inflation even means, is basically like imagine that your grandma has $300 and she puts it under her mattress to buy a TV at some point in the future. Now that today a TV costs $300, but now next year because of inflation, that same TV, let's say for now costs $315. So her $300 is still under the mattress, but it's now not enough to buy the TV that she set out to buy in the future. Now, that's how inflation eats away at your savings, and it takes money and makes it worth less over time because of the increasing prices that exist within our market today. And there's more complex processes. We won't go into that, but broadly speaking, it's because central banks print money and therefore the supply increases, which means that money then becomes less worth over time. But this is not super important. It's just important to know that your money will reduce in value over time. This is why it's so important to invest, because savings account often offer low interest rates. So now an interest rate is when a bank gives you money as a reward for storing your money with them, because they can then use their money, your money within their internal systems, and then whenever you want it back, they will pay it back out to you. So you get a little bit of a reward for giving you their money. They're giving them your money, basically. And now it's, I don't have to be a math professor to be able to tell you that with these low interest rates that often exist within banks of about 1 to 2%, you won't actually be able to grow your money over time because that's almost like as much or even less than inflation. Therefore, inflation reduces your money, the value of your money over time. The interest rate increases like your savings over time, but not enough to actually often cover even this basic amount of inflation. Therefore, it's really important to invest because investing lets you grow your money faster than inflation eats away at your savings over time. Now, time is your biggest advantage. You earn returns on your returns, and money grows exponentially. If you start younger, the younger you start, actually, yeah, the more you will be able to earn in the long run. This is because of a process called compound interest. Now, what you can see here is the spreadsheet in front of you, basically showing you how, you would be earning money if you put $100 into your savings account every single month. So you would have, after 1 year, after 12 months, you would have 1,200 saved without an interest rate. And then we have other like forms of interest rates next to that. So now imagine you have $100 in your savings account that earns 5% interest per year. Now, after 1 year, you will have $105. But in the second year, you earn interest not just on the original 100 that you put in, but also on the five extra from the first year. So, you can see here on the 5% column that, you put in $1,200 and you will then earn interest on the 5% that you've earned in your first year within the second year. And then in the second year, you will earn interest on the money that you've already earned interest on. So this is why it's an exponential growth curve that you can experience here. And especially when you're young, this is really sensible because as you can see here, the longer you let your money just sit in your savings account, I mean in your investments and let it compound with these interest rates, you'll be able to exponentially grow your wealth. Whereas if you had no interest and you had, put your money into a savings account, after 50 years, you would have had $60,000 if you had put $100 into your account every single month into your bank account. Whereas if you had, for example, invested your money with 5% and average annual returns, you would have then had, instead of 60,000, now $267,977. That's like an insane amount more. And if you had put it in an investment form with a 10% interest, you would have had $1.7 million. That's like insane. So this is why if you start young and you just stay consistent with a small amount, it doesn't have to even be 100. It could be, $10 or something. Like you will actually earn a lot for something that's very low risk and you can completely automate to do for you every single month as you get your paycheck or your student allowance or any kind of payment. So just to drive this thing home, the sooner you start, the better. Now, why do we care about passive investing? What is passive investing? Passive investing allows you to let the market work for you. You don't pick individual stocks. Instead, you buy the whole market. ETFs, also called exchange traded funds, track major indices. Now, we will explain in another video what an ETF is, but basically, you can buy a pool of stocks very easily. It's really accessible. And you can, instead of buying one stock or doing ages of research on a single stock to buy, whether that is Apple, Microsoft, these big companies, if you want to choose one of them or any other company for that matter, you can instead buy, let's say, the S&P 500, which is the top 500 companies traded in the United States, the largest ones, and these companies, they just tend to do really well in the long term. And they always grow. They've always historically grown, I think, more than never have decreased in value for more than 5 years in a row. So if you hold your investments for more than 5 years, you will tend to make money. Um, and there is no need to time the market or follow the daily news because you will be able to just buy passively these ETFs and you'll be able to make money in the long term, which is super easy, completely automatically doable. And just to give you an example, if you had invested $1,000 in an S&P 500 ETF 10 years ago, it would now be worth over $3,000 today without you needing to do much about it. You can literally buy this thing once and then just hold it and never care about it again. So there's a real benefit for you to learn this, the younger the better. Now to the risks of investing and why you shouldn't worry. Market fluctuations occur. Prices go up and down, but they always recover in the long run. There can be a serious drop, right? You might experience a financial crisis and suddenly all stocks decrease by their value by 50%. And let's say you look at your portfolio and you think, oh my God, I've been investing into these ETFs and now they're all worth 50% less, right? And now this is the cliff. You see the cliff, and a lot of people, they end up jumping, right? And that's the worst thing you can do because these ETFs, they track so many companies and the whole market experiences a drop. And so it's, just something that happens in the long run that they will end up recovering. And then you will really regret that you lost a lot of money by locking in these losses, by selling out, when you could have just kept your stocks and just not cared about, the short-term drop, because in the long term, they will always recover. And, emotional investing is a big problem because a lot of people panic sell. A lot of people, buy stocks randomly when people tell them, like people that don't even have invested a lot in their past as well. And a lot of people that read some random news article and then end up buying a stock. It's, having a set strategy and just having a set and forget way of investing every single month into certain ETFs will be a more long-term viable strategy. It's not a get-rich-quick scheme. You won't get a millionaire overnight with this, but with patience, you can most certainly become a millionaire in the long term because you will be able to, benefit from compound interest and be able to take the long-term rewards of a growing market that has occurred always in history. And to give you some examples, in 2008, the stock market crashed by 50%. but it recovered to grow even higher in 6 or 7 years or so. So let me show you this actually on a graph, just to show this to you. Um, and so, for example, here we have the stock market, the S&P 500 index, what I told you about before, which is basically a way of tracking the top 500 companies in the United States, right? The S&P 500, the top 500 companies in the United States. In 2008, there was a massive financial crisis that has caused global markets to go into the toilet. They basically decreased in value significantly in a very short period of time because there was a big banking fraud case that has caused companies to basically go like a lot of companies to go bankrupt and not do well. And so confidence was really low in the market. The share price dropped a lot from a lot of companies. And the S&P 500 index, I think it decreased by about 50%. If we zoom in here, we can see that better. And so it dropped all the way down to 739 here. But then if we see here, let's say we bought like ETFs here. We bought at this top point. We were like, yeah, the market's going well, like everything's going up, like, it's a no-brainer. I'll just buy this ETF or whatever. And suddenly, then everything starts going downhill. And, a lot of people start freaking out. But for the people that are smart, that know how to invest and know that the market will recover in the long run, they wouldn't have sold. They would have kept. And after about, if we check the line here, another 6 or so years, they would have made their money again. And in the long run, they would have then gone to make lots more money in the long run to now where it is currently at, 6,000 or whatever. It will just keep going up in the long run. So that's about risk. There is the long-term growth that always occurs. And so you shouldn't be too worried when the market goes down and when you see red figures on your ETF portfolio. It's really something normal that will occur from time to time, but in the long run, you will definitely make a lot of money with this. And so active versus passive investing, just to kind of break it down a little bit. Active investing is if you actively choose certain stocks or investments, whereas passive investing is that you choose a certain index or a certain ETF, like a group of companies, what I've explained before, and then you just passively invest into that. So it's very hands-off approach because you buy and just hold. Whereas with active investing, you seek to outperform the market with individual stocks. And you frequently buy and sell to take the highs and lows. So you end up spending a lot of time trying to do this. Whereas with the passive investing strategy, you just track the market. So you don't try to outperform it, you just track it. It's way more hands-off. It's typically very low costs because these funds, they often have a little management fee. So the company that brings, this investment product together, where you buy and you have hundreds of companies there. This is also something that will be explained in more detail in a later video. They will charge a little bit of a fee. This is generally very low fee, like, 0.5%, 0.2%, something like this. And then for active investing, you generally have higher prices because you have to do a lot of research and then you pay trading fees. So when you buy and sell a stock, often you pay a small fee. And when you buy an ETF once a month, like that's not a lot, like you maybe pay a few dollars or something. But when you buy and sell stocks like several times a week, those costs, they really add up. They become quite large. And also, if you then make a wrong move and you end up buying and selling a stock at a loss, that comes additionally to your costs. The risk is lower with passive investing because you have a diversified portfolio. You buy, say, the S&P 500, 500 companies at the same time. And you can start with a little bit of money, like, $25. And then you have the S&P 500. And, even if one of these companies goes bankrupt, your S&P 500 index will decrease slightly in value. Whereas if you buy and hold a stock and that company that you bought the stock of goes bankrupt, you lose your money. It's a higher risk. Whereas with the passive investing, it's a lower risk. The time commitment is very low in passive investing because once you set it up, you can automate it so that every single month automatically you buy, say, 3 or 4 ETFs with $100 a month. And this is completely automated. So you don't even have to do anything about it. And it just does it every single month for you. Whereas for stocks, and for active investing, you require ongoing analysis. You have to monitor the market. You have to understand the market. You have to do a lot of news reading. You have to constantly monitor the prices to see that you're not going at a loss. And it takes a lot of time. In terms of the performance, passive investing aims to match the market performance, whereas active investing seeks to beat the market through, though not all active managers succeed. And research has actually shown that about 90% of active fund managers do not succeed in outperforming the S&P 500 index that we've talked about. So that comes on top of that, that 90% of people that try to outperform the market will actually not end up outperforming the market. So it's really, really difficult to do that. So in terms of key takeaways, investing grows wealth over time. ETFs and passive investing, is the best strategy for beginners because, I bet a lot of you are not a C-suite executive or manage a massive company that has insights into the inner workings of many companies. So it's really, really hard to actually know whether a stock price will increase or decrease in time. And so it's really effective to just passively invest into the market and benefit from the long-term growth of it that we've seen over the past, 100 years. And the earlier you start, the bigger the rewards. Compound interest is your best friend. Just to go back to the example that we've mentioned before, if you had simply saved 100 euros per month without interest, you will have 24,000 euros in 20 years. So 100 euros per month without interest, you have 24,000 euros after 20 years. But if you invest 100 euros per month with a 5% annual interest, with a compounded monthly growth, you will have 41,274. So you will have gained 17,274 because of compound interest. So yeah, starting early helps you gain more wealth in the long run. So don't fear market drops. Stay invested and focus on the long term. If you buy into these broad ETFs, there's not really much that can go wrong in a 10, 20-year time horizon. And this is kind of the long-term outlook that is recommended. Looking long-term and investing like this is really, really effective.